Hello everyone. I will cover Chapter 8 in this lecture. This chapter is about government regulation of insurance. These are some of the concepts that we will cover in this chapter. So we start with what are the major drivers for insurance regulation. The first is to ensure solvency of the insurance company so that they can serve their customers on a continuing basis. It is also to protect consumers because they may not always have sufficient knowledge. Regulation also ensures reasonable rates and pricing and makes insurance more readily available across the country. So we look at some of the landmark court judgments which have helped to develop insurance regulation. The first was the Paul versus Virginia case in 1816. The Supreme Court ruled that insurance was not interstate commerce and the states had the right to regulate this industry. In 1944, in the Supreme Court judgment in US versus Southeastern Underwriters Association. In this case, the court ruled that insurance was interstate commerce when conducted across state lines and hence subject to federal laws. To remove the confusion because of these two judgments, the government enacted McCarran-Ferguson Act. This law states that federal antitrust laws apply to insurance only to the extent that insurance industry is not regulated by state law, which means that insurance industry will be regulated by state law in domains where the state regulation does not apply, federal and antitrust laws will apply. The next important legislation was the Financial Modernization Act of 1999. This removed restrictions for financial companies to compete outside their core area. As a result, there was a lot of overlap in their business. Because of overlap in their business, it also led to overlap of regulatory agencies. The Dodd-Frank Act was enacted to ensure better risk management and prevent undue risk taking in the financial services industry, especially after the financial crisis of 2008. This act created the Financial Stability Oversight Council. We will discuss about this agency in more detail subsequently. So what are the principal modes of regulation? First is legislation, that is enacting state and federal laws. Then comes the court decisions, which basically interpret the laws and apply in different scenarios. And that sets a precedent. And we also have the state insurance departments, which includes the insurance commissioner. The first area of regulation is formation and licensing of insurance companies. So to get license to operate in a state, insurance companies need to meet minimum capital and surplus requirements. A domestic insurer will be chartered in the state. A foreign insurer will be chartered in a different state, but will be licensed to operate in this state. Alien insurer will be chartered by a foreign country, but will be licensed to operate in this state. Insurance companies are also subject to regulations to maintain solvency, because if they are solvent, they can continue to operate and serve their customers. So their assets must be sufficient to offset liabilities, and they can use admitted assets, which is shown in their statutory balance sheet. The states also have regulations regarding the calculation of reserves, and they monitor the surplus position, that is asset minus liability position of the insurers. The life and health insurance companies have additional risk-based capital standards. So the Insurers have to allocate capital based on the risk profile of their investments and their insurance operations. The total adjusted capital of the company is compared with their required risk-based capital, and accordingly, corrective actions may be required. So you can look at the comparison of risk-based capital with the total adjusted capital of the company. And based on different levels, there would be corrective action required. Another area of regulation is the investments. So insurance companies invest in different financial instruments to earn returns, but they must not make risky investments which may impact their solvency and harm the customers. That's why the states have regulations in place to limit the share of investment across different categories. Some states also limit the amount of surplus that the insurers can maintain. Basically, they want the companies to pay off their customers with the excess surplus in form of dividends. The insurance companies have to file annual reports with the regulator in order to maintain transparency. The state regulators maintain guarantee funds, guarantee laws, and guarantee associations. This is required in case an insurance company becomes insolvent, and this regulator has to step in to protect the interest of customers. Rate regulation is also done by the regulators. That is, they approve the rates and premiums that will be charged by the insurance companies. More specifically in the case of property and casualty insurers. But they do not have such regulation for rates applicable to large commercial accounts. There is no direct regulation of life insurance rates because there is strict requirement for policy reserves. That in a way has a consequence on the rates and premiums decided by life insurance. Life insurance companies also need to seek approval from the state regulators when they want to launch a new policy. The idea is the customers are protected because the policy details may be complex and may not be easily comprehensible to the ordinary customers. Sales and distribution is another area of regulation. The insurance agents and brokers need to be licensed. They also need to undergo training and be certified about their knowledge and skills. Insurance regulation also tries to prevent unfair trade practices. A prominent such activity is twisting. In this case, the company will influence the policy owner to shift to a new policy, which may not have any economic benefit for the customer. Another malpractice is rebating. In this case, the company will provide financial incentives to the customer, which is not mentioned in the policy. This is to influence the customer to buy a policy. State regulators also have a complaint division where they take care of customer complaints. They also provide information to customers to help them become more knowledgeable about the insurance products. The insurers have to pay local, state, as well as federal taxes. Most of the states have retaliatory tax. It means that the state will tax out-of-state insurers when they are doing business within that state's jurisdiction. Since most states have retaliatory tax, it protects the domestic insurers from high taxation when they are doing business in a different state. So that's all for this part of the chapter. I will continue with the rest of the chapter in the next lecture. Thank you.